Are you all surviving the time change? Unless if you're lucky and you live in Arizona. Well, to help you survive, I'm going to go over 5 must-have stocks. Now, these are stocks that you want to hold for long term, and I think they'll provide some great returns and give you a great reward. Now, what I'm going to do is I'm going to talk about 2 stocks that I do have in my portfolio, and then 3 that I do not. And one of them is new. I've never talked about it before. The other one, I don't think I have either. One I've talked about a few times. Regardless, this is going to be a great video. You definitely want to tune in, and we're going to get started, and I'm going to pair the first 2 together, and those 2 stocks are Realty Income and Vici. Now we're going to start with Realty Income and looking at some financial aspects. Its income statement, we will see its revenue is increasing, though its net income is declining along with the profit margins, but that's usually due to the high expenses that this company puts up for acquisitions and other types of property related items. So not a red flag for me at all. So now if we look into the balance sheet, we will see that overall the assets are increasing and that debt to assets went down this last quarter. So the balance sheet is looking good. Now with these REITs, you don't want to necessarily look at free cash flow. You want to look at adjusted funds from operations. Now with Realty Income, they had a 9.2% growth year over year. They also have a 5% historical average growth rate since 1996, which is above the industry average of 4.2%. Now we have to talk about the acquisition of Spirit Realty, and Realty Income is paying a 15% premium. Now this will increase its competitive advantage when competing for large-scale transactions. This will also make Realty Income the 4th largest REIT out there in the market. Now Spirit Realty, what I liked about it is it has a 99.8 occupancy rate. That is fantastic. Overall, this looks like a good deal that will expand Realty Income's moat and growing potential. I like to think of it like buying a home. I bought my house 10 years ago. It's more than doubled in its appreciation, so we'll just say I have 100% returns. And looking back, would I have turned it down for a 15% premium in price? Absolutely not. Most quality property is an appreciating asset, and I think it's just fine to pay that premium upfront on a REIT that I'm sure Realty Income has done its homework on and will appreciate far beyond that 15% premium if you're a long-term stock holder. Now let's talk about Vici, and then we'll kind of talk about both in the end. If we look at Vici's income statement, we will see that the revenue is going up over time. Now the net income and profit margin is kind of doing this up, down movement, but overall there's nothing red flag here for me. With their balance sheet, we do see the total assets going up, and that is good, right? They're acquiring more properties, and that debt to assets went down 2 quarters in a row. That is great to see. Now their AFFO is very attractive. It grew 16.4% year over year. So that's great. That's one of the main reasons why I love this REIT is they're just growing in so many areas. And look, Vici, they have an amazing opportunity in a unique segment that's experiential properties with a solid future growth runway. It operates very conservatively, but goes after that growth boldly. I love that combination. From bowling to gambling to shows to dinner to shopping to wellness to golfing and more in desirable locations like Las Vegas that will help amplify the traffic to these properties in one-of-a-kind, unique properties. These are things that will continue to be well sought after by the public. I have strong conviction that Vici will be much bigger than it is today in the future, and that is why I'm so bullish on this REIT. Let's quickly look at the stock facts. I'm going to just focus on the dividends. You can take a look at some of the other metrics, but we kind of went over some in the prior slides. The dividend for these companies is hovering at 6% or above. That is high, on the high end for these companies, and that's excellent right now because these two can definitely pay that. Don't pay attention to that payout ratio. REITs, they utilize the depreciation, which throws this number off, but what I want you to look at is the growth over the 1 and 5 years. Now, Realty Income grows slower in the low 3% range, and Vici's been growing in the 6.5 to 7.5 range. So these are definitely stocks that will provide you some good income. REITs also are the way to invest in property without having to go through all the trouble of actually buying physical property and upkeeping it and all that mess. So this is what I like to do, and these are the 2 best REITs I think in the market and why they made my must-buy list. Next, we're going to look at the 3rd pick for the must-buys, and that's Caterpillar. Now, Caterpillar manufactures and sells construction and mining equipment, off-highway diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives in the United States and internationally. But I want you to focus on construction. That's what we're going to talk about. But let's look at their financials first. They just reported earnings, so these are updated. The income statement, they show that the revenue is kind of staying flat. It's holding strong, so shall we say. The net income has gone up a little bit down this last quarter, but overall it's a rise up, and the profit margins are holding strong. They rose up and they're holding strong, so I think this is a good sign. If we look at their balance sheet, we'll see the total assets are going up with that debt to assets going down. That's a great combination. Balance sheet is looking good. Free cash flow wise, I love to see this with their last earnings. The highest free cash flow they've earned yet over the last 5 quarters. If we look at a year ago, they more than doubled that free cash flow. This is something you definitely want to see in a stock. Now, if we look at their stock facts, we'll see that their trailing 12 months PE is below their 5-year average. So to me, that means it's kind of an valuation that is attractive. They also have revenue that's growing almost 20%. They have healthy gross margins, return on equity. Their debt to assets is low. That total debt to equity is high, but I think that will start to reduce with the increase in their free cash flow and see what they do with that cash, meaning they won't have to take out much of that debt to equity. So with their dividend, they're above that 2%. They have a very low payout ratio of 32%. That's awesome. That means they're going to have more room to grow that dividend, which shows right here they're growing their dividend in the 1 and 5 year time periods above 8%. So that is very healthy. Now, CAT reported solid earnings with sales growth, but did say equipment demand may decrease in Q4. They also noted that they have hopes that larger mega projects do stay on track, like EV plants, battery plants, and large oil and gas installations. The move to renewable energy is a great opportunity for CAT and its future revenue growth. Business in China and Latin America is declining or remaining flat in some areas, but in North America, business remains strong and growing quite well. So CAT depends heavily on construction, and that's why this made my must-buy list, as we are entering an infrastructure revitalization need in North America at a large scale. I don't know if you've driven to any neighboring state or gotten out there. We need help in this area. In fact, the jobs numbers were just released on Friday and showed that the construction sector was amongst the top 4 sectors to show new jobs growth. That is something I love to see. And this is great as the overall jobs market, on the other hand, is cooling and unemployment is rising, but CAT is remaining above that. Now, our current infrastructure is in poor condition, is deteriorating, it's old and behind the likes of many other developing countries. I think the stock will be a play on our need to upgrade our infrastructure, the continued expansion of that infrastructure, as well as the renewable energy movement that will create a boost for the need of equipment on those mega projects I mentioned. I see this stock as one that should outperform over the next 2 to 3 decades and probably beyond, and it made my list of must-buy stocks. Now we're going to move on to the 4th must-buy stock, and that's one you might not have heard of. It's kind of a newer company, maybe a little bit higher risk, but I think higher reward, and that's Health Equity. Now, Health Equity is in the healthcare sector and healthcare providers and services industry. This company offers cloud-based platforms for individuals to make health savings and spending decisions, pay healthcare bills, compare treatment options and prices, receive personalized benefit and clinical information, earn wellness incentives, grow their savings, and make investment choices and health savings accounts. This is the bread and butter of this company. They also offer flexible spending accounts and health reimbursement arrangements. If we look at their income statement, we will see something impressive. Growing revenue, a move from a net loss to a net income, and profit margins that are growing. This is a great sign. As far as their balance sheet goes, we will see the assets are holding strong, but that debt to assets is going down. So that is bringing up the positive side to this, which I like. And then the free cash flows, we saw some positive here. They had 3 quarters of negative free cash flow, but then it bumped up this last quarter to positive. So I think this company's starting to move towards profitability with that net income, this free cash flow popping in the positive. These are great things to see. Now, if we look at its stock facts, we'll see the trailing 12 months PE ratio is dramatically lower than the 5-year average. That means it's growing into its valuation pretty rapidly. And so a lot of these metrics are going to be high, like the price, profit, and cash flow and things like that. But you're buying now for that potential future growth, so you're paying a little bit of a premium, but I think it'll pay off very well into the future. The revenue's growing 18% over the trailing 12 months and 30% over the last 5 years. They have good gross margin number. The return on equity needs to improve. I think that will improve as this company matures. Total debt to assets is low as well as debt to equity. Love to see that. They don't pay a dividend if that's something that matters to you. A health savings account. If you don't have one, I highly recommend you consider it. Health savings accounts, they are a triple tax advantage account. Contributions are made pre-tax, growth is tax-free, and withdrawals used for qualified healthcare expenses are also untaxed. That is amazing. I think this type of account will only grow over time in popularity as an investment and retirement tool. You must have a high deductible plan, health plan shall I say, in order to have an HSA, but the benefits are amazing. In fact, you are lowering your taxes by making contributions that are pre-tax or tax deductible. You are able to pull from a savings account to pay for those out-of-pocket costs that your health insurance doesn't cover. So it's allowing you to have some of that confidence and stability there without having to dig into your current checking account or something like that, or use a credit card. You have the savings account specifically for health-related items. Also, you can utilize it as a retirement tool. Once you reach a certain age, no longer do the money you pull out has to be made for health-related expenses. You can now just pull it out and use it as a retirement account. So that is what most people do, is they try not to touch this account, so when they reach retirement, they can just pull it out and use it for whatever they want. That's amazing. And the money you put into your savings account, it rolls over year after year. You can use that money to invest in the stock market. So I think it makes you hold $2,000 in cash. Anything above that, you can choose a fund to invest. So it's just such a great option. There are contribution limitations, but over time, this can grow to significant savings if you max out each year. With the rise in healthcare costs, it is a very beneficial account to save money and be prepared for any future expenses knowing you already have the funds. So why I think this company is a must-buy is due to what I believe will be mass adoption in the future, and Health Equity is the #1 health savings account administrator. And we see what happens when a company is a market share leader, especially in the early adoption phase. It usually ends up being an amazing investment if it can keep and grow that market share. They currently have just over 14 million members, so I see a potential blockbuster of a stock, and that's why it made my must-buy list. The last stock I'm going to mention, they just reported earnings, and some of you might be questioning this stock, though some of you might see the legitimacy of it. But regardless, let's get into it. That's Apple. Now, like I said, they just reported earnings, so let's look at their financials. If we look at their total net sales, their sales are actually going down. The 3 months ended of September 2023 versus 2022, and the 12 months ended, comparing the 2 years. Also, the net income did pop for the 3 months ended, but it went down when you compare 12 months versus 12 months. And the earnings per share did rise in both situations. But if we look at the net sales by category, anything highlighted in green increased in sales, anything in red decreased. So you see a lot of red here, right? And you might be wondering, okay, I don't see where this is going, but I will get there. So iPhone, the 3 months ended versus last year compared to this year did increase, but the 12 months went down. And then Mac, iPad, wearables, all that revenue, all those sales went down, but services stayed strong when you compare year to year. Overall, though, the total net sales is down in both situations. So not looking great, right? Let's keep digging in though. If we look at their cash and cash equivalents, they are increasing. This is the balance sheet. The total assets went down slightly, so that's not a red flag or negative for me. It's barely going down. But the long-term debt went down. The total liabilities went down. So this is where the positive comes in. We start to see the strength of Apple, and the balance sheet to me is looking great. Now, free cash flow, the one thing that we always want to look at and factor into our decisions. We are seeing the free cash flow did go down comparing the 12 months ended for September 2023 versus 2022. It was $111.4 billion. Now they reported $99.6 billion. So how you get to free cash flow is you take the cash generated by operating activities and you take out the acquisition of property, plant, and equipment. So you might be saying, well, their free cash flow is going down. That's not good, right? Well, as investors, we have to analyze things in a deeper way. So we're going to look at the free cash flow quarter by quarter. So this chart, I wrote in with very messy writing, the free cash flow that came in now at the $99.58 billion. And you'll see the last September 2022 was $111.4 billion. So that was the decrease. But I circled in green everything else, all the other, 5 quarters there. The free cash flow now in September knocked those other ones out of the park. So This is why you got to see things in a different light. The free cash flow is still very strong. It's still really robust. And I think we've just seen a little bit of a slowdown due to the economy and those big purchase items like iPhones and stuff. People are just thinking twice about that. So free cash flow looks good to me overall. So we have sales declining, yet the balance sheet looks good, but free cash flow declined. So should we be worried? Why did this make my list? Well, there's 3 reasons why, and it's easy for me to say why. That's the moat of this company, the ecosystem, and the services revenue. Let's talk about the moat first. Apple has a huge competitive advantage. They make the device that you use to utilize virtually every other business out there, your iPhone. Think of all the apps you use. Are you using their product to get their app? No, you're using Apple's product to get their app, there being other companies. That's powerful. That's the moat, the competitive advantage of Apple. Now, if we talk about ecosystem, Apple has a deep and wide ecosystem that users get further and further into, and that makes it harder and harder for them to get out of it. It is the ultimate customer retention tool a company has, and Apple has one of the most robust and stickiest ecosystems out there. Think about it. The iPhone, AirPods, Apple Watch, Apple TV, Apple Fitness, iCloud, etc. They all work seamlessly together with each other, and once you have all those quality products and services, why would you spend the time and money to switch to another company's products and services that does not offer nearly as much or have the history you've built up with Apple? So their ecosystem will keep and grow its customers in the future. Then we have services revenue. The best part of this, the reason why it really made my list, is despite a slowdown in most of its product sales, which I believe is due to the tough economy where consumers are pulling back spending, though I see that reaccelerating in the future quite confidently, we see service revenue growing, which tells me services, aka subscriptions, those monthly payments customers make, is the robust category for consumers to increase spending on during a time we are seeing a tightening of spending from consumers, especially on high dollar items. This is where companies that offer good services will prevail and grow because that subscription revenue is predictable, dependable, and one with high margins. Subscriptions are also something many forget about and keep on paying for it, and it's easier for companies to raise prices on these services without people canceling. These subscriptions are auto-drafted from your account, and therefore it's not only convenient, but the customer is less likely to alter it because it's a set it and forget it payment. This is a brilliant way for companies to make money, and I feel Apple will grow massively in this area. So these 3 main reasons are why I have Apple on my must-buy list for the future growth it will provide us investors. Now let's take a quick look at my portfolio performance. This is the transparency I offer you guys, the honesty, and if you like that type of content, be sure to subscribe. Now, just 1 week ago, I was up 2.5%. Now I'm up 9.6%. What a difference a week makes. Of course, the Fed is holding rates steady, so people are thinking this is the end of any future rate hikes, and the only thing that can happen now is them going down. We shall see, but you'll see Vici and O, these are 2 stocks I talked about. They're still in the red for me. I still think they're at great valuations to buy and hold long term. If you have any questions on any of my companies, just let me know. Also, let me know if you agree with my list of 5 must-buy stocks, or if there are any you would add to this list that you think are better. Don't be shy to let me know your agreements or disagreements. This is how we learn together. So that's all for today. I hope you guys have a wonderful rest of your weekend or week, whatever it is, and we will see you soon on Mark Arnold's Finance.